You're listening to the Learn Like a CPA podcast, where we talk about all things real estate, tax strategy, and personal finance. Whether you're a real estate investor looking to scale your portfolio, or you're an individual wanting to take your financial freedom journey to the next level, this is a podcast for you. Welcome back, everyone, to the Learn Like a CPA show. I'm your host, Ryan. Today, we're going to talk about 6 tax planning tips for year-end. As I currently film this podcast, we are in the end of September. The first tax planning opportunity I want to talk to you guys about is doing Roth conversions. So a Roth conversion is where you have money in a retirement account that's either a traditional IRA or a traditional 401k. And a Roth conversion entails you taking that pre-tax money that you got a tax deduction for, converting it over to Roth, paying the taxes on it, but then that money that you convert over is now in a Roth account, and it's going to earn and grow tax-free for the rest of your life. And the reason why this is so important is because look where the stock market's at today. Year to date, the S&P is down 20 to 25%. If you've been investing in the stock market, your account's probably down this year. So this year is a great opportunity to do Roth conversions when the market is down. Let's say you had $10,000 of traditional pre-tax money invested. You got a tax deduction of $10,000, but maybe now your account's worth 8 or 7. If you're able to convert that Roth money, convert that traditional money over to Roth at 7 or 8,000 instead of the 10, you're able to save so much money in taxes over the long time because you got your tax deduction at 10,000 and now you're converting at 8,000. And that money's going to grow tax-free for the rest of your life. It's a great opportunity right now when the market's down, because also I'm converting less over. So when I had 10,000 before, and let's say I'm in a 30% tax bracket, it would have costed me $3,000 to convert the 10,000 over to Roth. But now that it's only 7,000 or 8,000, it's only going to cost me between $2,100 and $2,400 to convert it over. So in down years on the stock market, it's a no-brainer to do Roth conversions. One thing I would say is be very cautious of where your marginal tax bracket is at. Your marginal tax bracket represents the amount of tax that you pay on every single additional dollar that you make. Okay, because in America we have a progressive tax system, which means the more money we make, the more we're being taxed on each additional portion, right? So my first $10 is getting taxed at 1%. My next $10 is getting taxed at this percent. That's how the tax system works. And so, for example, be very cautious of the tax bracket cliffs. So a single person earning up to $170,000 is in a 24% tax bracket, okay? As soon as they make more than $170,000, they jump from a 24 up to a 32. So what we don't want to do is do a Roth conversion into a higher tax bracket, right? So we wouldn't want to, let's say we made $160,000 that year. We wouldn't want to convert $15,000 of Roth money because $10,000 of that would be at 24% and the other $5,000 would be at 32%. We don't want to do that. Be very cautious of your brackets, especially if you're in the 24 to 32%. As well as the 12 to 22. So we have a 10% tax bracket, a 12% bracket, then it goes up to the 22, then it goes to 24, then it jumps up to 32, 35, 37. So if you're in one of those big jumps, whether it's the 12 to 22 or the 24 to 32, be very cautious when you're trying to do this because you could be paying some more tax. The ideal strategy would be convert up to that amount, but nothing further, and then look to maybe convert it the following year when your tax bracket resets. The last thing I'll say about the Roth conversion is you want to make sure, if you can, and this is going to be dependent upon your 401k plan, your brokerage, wherever you're at, do not withhold taxes on the conversion. Instead, opt to pay them out of your own pocket or when you go to file your tax return. And the reason being is, let's say I do have $10,000 of traditional IRA money and I go to convert it to Roth. Well, that plan administrator is going to ask me, do you want to withhold taxes on the conversion? Well, what happens is that $10,000 that I had in traditional money that I convert over to Roth, I'm going to take 20% or 22% out to pay the taxes, and then I'm only left with $8,000 in that Roth account. We don't want to do that. What we want to do is convert the $10,000 over to Roth, elect to not pay taxes there, because that $2,000 that we're paying to taxes could have been in that retirement account that's super charged and that's going to grow tax-free for the rest of our life. Pay the tax with out-of-pocket dollars. Pay the tax without the retirement money. This is probably the number one mistake that I see people make when they go to pull money out of their 401k or they go to do Roth conversions, is withholding tax. We don't want to withhold tax if you can. The second tax planning tip this year is going to be to take advantage of the last year for 100% bonus depreciation on your properties, on your financing, on your vehicles, etc. Whether you're using short-term rentals and material participation, or maybe you're using long-term rentals, you're accelerating tax benefits, this is the last year where you're going to get 100%. Okay, in 2023, it's going to drop down to 80%. 2024, it's going to go down to 60, and then ultimately it's going to go down to 0. We want to take advantage, if we have the assets, take advantage of 100% bonus depreciation this year, because it's going to be worth 20% more than if we were to take advantage of it next year. Tax planning tip number 3, check your Form 8582 for passive activity losses. This is the most important form if you're a real estate investor, and I tell everybody this. The 8582 on your tax return represents the amount of income that you can make without being taxed. Rental income that you can make without being taxed. And what it is if you look, it's normally towards the end of your tax return, but it might say, hey, Ryan's got $100,000 of passive activity loss carry forward. So what that means is I had $100,000 of losses in previous years that I wasn't able to take, depending on my tax bracket, my income, etc., my participation in the property, but I'm able to carry forward those losses until the following year. So I've seen where clients, they have $200,000, $300,000, $400,000 of carry forward losses that they're able to roll forward to the following year, but they're still trying to strategize, do other creative strategies when they already have it covered because of their loss carry forward. Check your form to see how much income you can make in the rental real estate space without having to pay taxes. And the cool part about these carry forward losses is that a passive activity loss will offset any form of passive activity gain. So maybe you have $200,000 of carry forward losses and you have $100,000 of rental income coming in this year. Well, that $200,000 of losses are going to offset your $100,000 of rental income coming in. You're not going to pay taxes on it. More importantly, let's say you sold the property for a $100,000 gain. You have $200,000 of carry forward losses. They're going to offset that passive activity gain of $100,000 sale. So double check this form. Use this for your tax projections and planning. Number 4, tax planning tip would be check your withholdings and do a tax projection to see where your income is, and then see if you have to make any changes to your estimated tax. This is going to be so important for my people who are working tech jobs or sales jobs, commission-based jobs, where you're going to get, some of your compensation or your salary up front in the form of a paycheck or W-2, but you're also going to get a big chunk of that in the form of stock compensation, ESOPs, employee stock plans, etc. Do a real good job of projecting out what your tax liability is going to be, because every single person that I know that gets stock options ends up owing money, because those stock options are never withheld at the proper rate that they need to be. I got clients in 35, 37% tax brackets that are paying 37% on every single dollar that they make, but their company's only withholding at 22%. It creates a very big problem when you're talking about hundreds of thousands of dollars of income. Come tax time, they're owing $20,000, $30,000 checks. Do a tax projection now. Look at how much you're expected to owe versus how much you've already paid in, and then you can make adjustments. If I'm expected to owe $50,000 total for the year and I only have $35,000 paid in, I know at some point I'm going to have to come up with $15,000, or I'm going to have to tax plan around that. And so make sure you're doing this. Right now is a great time to do this exercise. And if you don't know how to do this yourself, pay an advisor to teach you how to do it, and then you can learn it for the rest of your life on how to do this. Tax planning tip number 5 is defer income as long as possible, but we want to be able to accelerate expenses. And the way this works is if I have an income event, let's say I have cash coming in from a rental property, or I sold a rental property, or a business, whatever it is, how can I push that liability? How can I defer that? Not get rid of it completely. Sometimes we can. But how can I defer that income event as long as possible? I can do that through accelerated depreciation. I can do that through 1031 exchanges, seller finance deals. There's forms that I can defer that tax burden, kick the can down the road, as they say. But if I have an expense, like if I have to come out of pocket for something, I want to be able to accelerate that quicker and be able to take that in the year that I have it, right? So if you think about like financing a vehicle, I just released a TikTok on why you shouldn't buy cars. But for a business owner that is using vehicles in their business, a great strategy is to finance a vehicle and get the tax deduction this year and pay that off over the course of the car. So for example, if I'm in let's say a 37% tax bracket, let's just call it 40 for easy math, and I buy a $50,000 vehicle, I'm getting $20,000 of tax savings, 50 grand times 40%. I'm getting $20,000 of tax savings in the year that I buy that vehicle. And oftentimes that $20,000 of tax savings is going to be more than the down payment that I had to put on the vehicle. And sometimes it makes sense to finance. From a tax strategy perspective, it's always best to finance the vehicle rather than paying it 100% cash. Why? Because whether you buy it for 100% cash or you finance it, you still get the same tax benefit. So it makes sense to want to finance it. If you lease the vehicle, however, you're just able to write off the lease payment. Another way to accelerate your expenses is to look at your vendor list. Okay, so if I'm sitting here and it's November or December, who do I have to pay between January and March of the following year? And work out some sort of program to be able to prepay those people so that way you can get the tax deduction this year, 2022, pay them for services or products or goods that you're going to need, that you know you're going to need in 2023 anyway. So you're able to prepay your contractors, your vendors, your tax advisor. You're able to prepay those people this year, get the expense this year, even though you're not using the service until the following year. Tax planning tip number 6, and this will be the last one today, is wash sale losses. Be able to use your losses, especially right now where most of the stock market's down. So if let's say I had a taxable brokerage account that, let's say I invested $100,000 and now it's only worth $80,000, I'm able to sell at a $20,000 loss and use that loss to offset maybe some gains that I might have elsewhere, maybe on rental properties or some business sale. You lock in those losses now and be very careful of the wash sale rule. But maybe I had an S&P 500 index that's down 20%. Okay, I can sell that, claim the loss, and buy back into something that's not the exact same thing, but maybe something that's similar or a little bit different. Buy back in right away so I can register that loss, but nothing changes to my investment portfolio. So that's what we're covering today, guys. We talked about Roth conversion strategies, 100% bonus depreciation. We taught you guys how to check your passive activity loss form. We talked about withholdings and tax projections and planning. We talked about how to defer income as long as possible and accelerate your expenses. And we talked about the wash sale loss rules. If you like the show, make sure you leave a review on Spotify, Apple Music, YouTube, wherever you're hearing this content. And let me know what you guys want to see in the next episode. I'm very open to hearing your guys' questions. So make sure you leave a comment. Let me know what you want to see in the next episode. And thanks for tuning in. And we'll see you on the next episode.